Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. This is part of the 1 million by 1 million program. We are a global virtual accelerator founded in 2010. And our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we've been doing these free mentoring roundtables since 2008, actually. It predates the program itself. This is the experiment that led us to the program. And we've done 724 sessions of free mentoring roundtables so far. All recordings are available on YouTube. Today is the 725th session of free mentoring roundtables from 1M by1M. Now, you know that we have introduced the AI mentor, the 1M by1M AI mentor, which is essentially my digital mind. It's trained on all these recordings, all my writings, all our curriculum, everything. So you basically have a 24/7 AI mentor in your pocket. So I like to say that if you're looking for a co-founder, make my AI mentor, my digital mind, your co-founder, and you can run every single decision that you are trying to struggle with or you're struggling with. You can run it by me. And that is going to be a good sounding board to have in your pocket 24/7. Okay, we're going to focus on one pitch, but before we go there, I would like to tell you a few things that we are working on and releasing significant research on. We have just published a bunch of research on the problem with excessive equity dilution up front that is creating a lot of problems downstream. So you will find all these, when I publish the recap for this session today, I will include links to all this, but basically, if you look at what's happening in the startup ecosystem, the term accelerator is being hijacked by a bunch of minuscule VC funds that are giving very small amounts of money for very expensive equity. So for 7 to 15% equity, they're giving anywhere between $50,000 to $150,000 to $200,000. This is super, super expensive equity, because what happens in the startup ecosystem right now is the early stage financing has broken up into segments. There's pre-seed, seed, post-seed, pre-series A, and then series A. So by the time you're getting to series A, you may have gone through 5 rounds of financing, 5 rounds of various flavors of seed financing. And you are diluting. At the very offset, you're diluting 7%, maybe 15% in some cases. And throughout the course of all this, by the time a founding team arrives at the Series A financing point, they're at below 20% ownership. And that really destroys the exit math. By the time you get to an exit, and that's the other side of the equation, is that exits, the vast majority of exits, 96% of the exits are below $100 million exit price exits. And the vast majority of those are below $50 million exits. So your investors are charging liquidation preferences and so on and so forth and diluting you down to such small ownership structures. By the time the liquidation preferences are settled, founding teams make very little money of these exits. There's maybe 4% of entrepreneurs out there who play a different game. Maybe they are getting the, much larger exits, $1 billion exits, $500 million exits, and they can play this game. But even in those cases, people are raising so much money later on in the Series B, Series C. People are raising so much money, and there's so much liquidation preferences stacked up against them, even in those cases, even with larger exits, the ownership, the equity ownership and the liquidation preferences are really destroying the math of wealth creation. If you are doing a startup, I have to believe that you have a desire to create some wealth for your family. So you really have to pay attention to early dilution. You have to bootstrap first and raise money later, as late as possible, so that you have ownership in the company and such that the exits work for you and exits create wealth for you. So there's going to be a lot more coming from us on this particular topic. We are going to have to, help these entrepreneurs who are being misled by equity charging accelerators, pre-seed venture capitalists, seed venture capitalists into diluting so much so quickly. There's a habit that has developed in the startup ecosystem. Entrepreneurs believe entrepreneurship equals financing. That is not true. Entrepreneurship equals customers, revenues, and profits. Financing is optional. Exit is optional. However, if you raise financing, you have to exit to give yourself and your investors a proper return on investment. But if you are bootstrapping all the way, you don't necessarily need to exit. The best case study of this is an Indian company called Zoho. Zoho has not exited. Zoho is 100% owned by the founders. It has no external shareholders. It has not gone public, and it has not been acquired by any company. So it has not gone through an exit. But everybody who is involved in building Zoho is insanely rich. They're making great money from profits. Zoho is an insanely profitable company. The employees of Zoho are well compensated. They have good salaries, good bonuses, and they are well taken care of financially. So this is a different model. I am not saying that you should not raise money. I'm perfectly okay. I don't have that extreme point of view as Sridhar Vembu does, who doesn't believe in raising money at all. But I do believe that you should build a capital efficient company such that you raise small amount of financing and make money of the exits that your company can go through. And if you there are certain issues that you have to keep in mind before deciding whether to raise money or not. But in general, just if you have to take one thing away from today's session, keep in mind, bootstrap first, raise money later, blitzscale later is a far better strategy than raising lots of money up front, diluting heavily up front, and ending up with very low ownership in your own company. Okay? All right. We are going to start with the entrepreneur pitch session. Let me set some expectations for those of you who are pitching today, as well as those who will be pitching in the upcoming session. Some people are auditing today how things are done to prepare for your pitch next time. Remember, this is a safe working session. We have no other agenda but helping you understand what's going on in your venture and give you keys to how to move forward. And that's the only thing we do in the mentoring work that we do. And we do intense, highly strategic mentoring work. Okay, you're getting a flavor of it here in the free roundtables, but this is what happens in the premium program on a weekly basis. You are very welcome to disagree with my feedback. All I ask is that you listen and you try to understand and analyze what I'm saying and act upon it. If you disagree and if you want to do something different from what I'm asking you to, that is your prerogative. This is your venture. You can do whatever you want with it. And if you ignore something that I'm telling you that is legitimate, you have the prerogative to put yourself out of business as well. I'm telling you all this because I sometimes deal with entrepreneurs here who argue with me and argue very rudely, vehemently, whatever. I'm fine with that. You can argue with me. I will not argue with you. I will basically ask you to stop and we're going to move on. But this feedback is generally very valuable feedback because I've seen a lot. I've been doing this for a long time. So please try to do something with it that helps you move forward. Swapnil, please unmute your line and let's work on your venture.
Hey everyone. So I'm Swapnil Srivastav. I'm based out of Noida, India.
Okay.
I've been in the software development industry for 12 years. I've worked my way as an engineer, then as a management person. And now I'm heading out to start my first venture. So Dawazan is the name of the company that I'm trying to pitch. It is a digital analyst for everybody in the capital market space. It works for all the documents, images, PDFs that all these big firms, family offices, PE funds, and LPs get. We have soft launched a website. It is a live MVP for 3 particular sets of documents, but we are still working to get more. Before I explain the problem, can you go to the next slide? Right. The alternate asset industry is throwing away close to $2 billion to folks who are financial analysts or clerical data analysts, which are doing work of manual data entry. And trust me, because alternate assets is such a new space, the documents do not come formatted. They come in all shapes and sizes. Somebody would like to send you bank details first. Somebody would like to send you the whole thing at one goes. There is a structured body who's trying to get it into shape, which is called as ILPA. But still, the chaos exists. And the way I see it, there are 2 major risks. First, because of all the manual entry part, it creates a lot of lag, all right, which I've mentioned here. You see a 2 to 4 week of lag in making reports, and these are high-stake portfolio data. A 2-week or a 3-week lag in that means decisions are actually being made on stale data. Second problem that I usually see is the errors created by people. So what happens is they have entered data into the system, the data has flown, it went through a bunch of accounting cycles, it ended up on their eFront or their Aladdin's or any of those kind of portals where they want their data, and then they see there is a problem. Even if it is a sense problem, it is a problem. It starts with the very starting. So the manual swarm is actually the costlier part in 2 ways. One's the headcount, and the other is the time that you lose. These are the problem statements that we're trying to solve, along with the part that we are trying to solve it for the global corridor. Right now, alternative assets revolve around only US and Europe-based documents. For a UAE cap call, for a Sukuk document, for an Indonesian document, there isn't much support. They get translated very good, but they don't follow the rules of the Sharia bond or the Sukuk bond. So we are trying to solve those as well. Can we move to the next slide? Okay, to fix what I just said, we have created Dawazan. It has 3 pillars. First is your smart extraction. The moment the document hits the system, we have exceptionally well-placed algorithm that tries to extract it. If it is an OCR extraction, we work on that. If we need an AI help, we work on that. We have trained models that will help us extract data as per your needs, not the system-specific ones. We have the capability for you to let it train, and extraction is not the point where we stop. We make that data recon ready. You can see everything that needs to be reconciled in minutes. Simpler that we have made is the NLP querying capability. So for now, for let's say Sramana, you are the head of a very big PE firm, and you want to know something like what is my IRR versus XIRR for a particular fund, or you want to know how good your geographies are, or you want to know which sector is doing better. You will reach out to your analyst, they will prepare a report, you will have that answer by the end of the day. That is the quickest you'll get that answer. We made that easier for you. You can just ask the system based on the documents that are present in the system, it will give you an answer. If it is a plottable answer, it will also plot for you. And third and most important point that I've seen in my experience in the space of capital markets is data getting breached. For one firm, for two firms, the data is getting breached a lot. We have created a secured local first vault, and we are trying to get the encryption as good and as well as for a SOC 2 compliant application for a fintech domain. So that's what we are trying to solve in the solution part.
Do you have background in the capital market data?
Yeah, I've been engineering manager in capital markets for Clearwater Analytics Private Limited. And I've done that for 3.5 years.
Good. And what is architecturally, how are you doing this? So is this, it's a RAG on top of LLMs, yes?
It's an OCR first, then RAG, and then LLM. And then also we have a, I don't know if you'll understand that well, we do not do a PDF first RAG. We are doing intent first RAG, which means we draw the intent out of the document, create a RAG on that, and then use it for querying. Because if you talk about just doing PDF first RAG, the first problem that we will hit is the footnotes. You know, the footnotes of documents that say, hey, please refer to page 4 for further details, lose it there. So we first convert it in intent and then we work on the data.
Okay. All right.
Yeah, so this is how I've structured my GTM. I'm targeting markets right now in UAE, India, and Singapore. And I'm trying to get 5 customers this first year while I'm still enriching my MVP to help people get where they want to get. But the milestone target for 5 customers that I've set is because there is a lot of friction for any firm to start trusting a new software. So that's why we've kept it to a very smaller milestone target. The next section that we'll be trying to hit is the US and UK, which already have a couple of platforms that do partially the things that we are doing. But then that is a bigger market, and we are hoping to get better response from there, along with what we are still getting in US, India, and Singapore. And that time we would be more trying to defend our product and trying to get people onboarded on that. And the third is we play with the platform and go global.
So can you double click down on your go-to-market strategy? What is the ICP that you're going after? Does that, I'm reading in the middle section, you're talking about mid-market family offices. Is that the ICP you're going after? Because in the earlier slide, just a second, I will go back there and show you what I'm talking about.
Yeah.
Second.
So
One second.
Yeah.
So on your first slide, you're talking about family offices, VC firms, PE funds, and LPs. These are 4 completely different segments, very different workflows, and very different documents.
Yeah.
So you want to let me finish, or you want to talk?
No, I want you to finish your thought, but I also want you to go one slide ahead where I tell you the TAM, SAM, and that part. Yeah. Now, please.
So if you're going to cover it here, we can get there. But my point is, I think you have talked about a very general and broad go-to-market strategy, and that needs to be tightened fastly. So
Absolutely.
geographically tightened, segment-wise tightened, and if you're talking about family offices in India, okay, that's 5, 15, 50 family offices in India, I think is a reasonable path. But you have Singapore, you have UAE, you have America, everything is on there, and 4 different segments are on there. I don't like that.
All right. Yeah, I do understand that. All right. So what I'm trying to make it as a serviceable ICT is family offices first. Okay. So if you see my SAM, I'm talking about 3,500 family offices.
Okay.
That is the first platform that I want to,
Geography.
Yeah.
With
I'm sorry?
Which geography?
Yeah. So 3,500 family offices is UAE, India, and Singapore. That's that.
It's too much. It's and too broad.
All right. All right. So how would you suggest? How would you want me to proceed with it?
Your experience is with family offices?
Yes. I also have it with VC firms.
So if you're saying that you want to go after family offices, your experience is with family offices in India, yeah?
No, I was servicing Hong Kong, US, and Europe.
Well,
I worked with a bunch of big firms as well. So I had worked with Allstate and KKR as well. And then I've worked with smaller family offices in Hong Kong and Europe as well.
but at an engineering level.
Yes, exactly, at an engineering level.
But to get these people to work with you now, that you're running your own startup,
Yeah,
you build relationships with these people who are willing to give you that job, right?
yeah.
That's a different ball game, completely different ball game.
All right.
So do you have relationships with these family offices anywhere in the world?
I have point of introduction. So I am since I've just completed my basic MVP, I have reached out to people to get introduced to people who put up money where this whole discussion is going. But to say that I have a foot in the game right now is not true. I have people who introduce me. I know their engineering leads, or I know people in their client services who were getting us introductions.
And where would those warm introductions lead you? Is that all over the world? Is that in India? Is that in Hong Kong? Where are those leads going to get you?
I am trying to get a couple of them in India as we speak. We are trying to get 2 family offices from Bangalore. And I'm trying to start with Indian firms first.
Okay,
because
that's my point. That is my point. I think your warm introductions will most likely get you to the Indian firms first.
Yeah.
Right? So if that's the case, that's fine. If you can get 5 Indian family offices and then 15 Indian family offices and 50 Indian family offices, that's fine. At least 5 to 15, you should work with Indian family offices and just focus this in and take out all this other stuff from the beginning of your strategy and validate your assumption that are they going to be willing to pay 100K ARR. And then the other thing that you have to figure out is, are they going to use your software, or are they going to ask you to do the job?
Okay. All right.
Because your experience is working for an analysis or analyst firm for those family offices. That's what you have seen.
Yeah.
So these family offices may not do a lot of this analysis themselves. They may be outsourcing to you. So what you need to validate is, what is the product? What is this? Are you selling a software product, or you're selling a AI-enabled service? and you have to accordingly build this company, structure this company. And I don't think you have the answer to that question yet until you actually swim in the waters where those family offices people are swimming, and you need to. But I really like the fact that you have real specific domain knowledge. But knowing, what documents, how much documents will vary across these 4 segments that you've talked about, I would really like you to pick. I'm fine with the family offices segment.
Yeah.
And I'm fine with it internationally as well. But I think you need to start with India and just make it manageable. Your, information is going to come to you from the Indian audience. You're sitting in India. Well, get the customers and get the money. And this is, the beauty of businesses that can charge $100,000 in ARR, especially if you can get the first tier payments in advance.
Yeah.
That's seed money, basically. That's very, very helpful. So
yeah,
yes, I like how you frame the problem. What is the competitive landscape?
all right. So what we're providing is unstructured to reconcilable. Okay.
Yeah.
Right now, there's nobody doing that. There are parts and segments that people are doing very beautifully. Let's talk about a very big company that does this. That's Kanu, right? It takes the documents, it maps to funds, and it extracts very beautifully. But that extracted data is of no use until and unless you do the math behind it and make it reconcilable, right? So Tanu then gives that data to another firm called as Accelerators, and then they work on the financial part of it. So to get one output, you needed 2 big firms in the league. Okay. We're trying to bridge that gap and make it work better.
You want to combine those 2 functions in your firm.
Yes, exactly.
Very good.
From a lot of extraction agencies that are present out there, a set of them are still on the older technology that use generic OCR. That means a lot of data is going into suspense, and they need to, manually fix things, and again, creating manual workload. We have, overcome that by giving them a studio to train the engine. So if it's my OpEx that's doing it, of course, we'll be training for those documents. But if you have your own operational field out there, they can train the system to understand the newer set of documents or newer set of work that you need to extract. So we've come up with.
I'm actually quite okay with what you said in terms of combining the functionalities of these 2 firms. And the part that I think, this is my hunch, you're going to have to validate it. You may end up with a situation where your family office clients are going to ask you to do the whole function soup to nuts with AI.
Okay.
Because these family offices typically do not have a lot of very savvy engineers and people who can, take your software and build this whole function. So it's very possible that as you get into the depths of these family offices and learn what they have and what capacity they have to use your software and do their job, I think you may end up with the feedback from these customers that you have to provide the whole thing.
Okay. All right.
Validate that.
Yeah, I might end up needing my own operations.
Yeah, you may end up doing this as a service. And if you look at Y Combinator's request for startups list, this theme is emerging. Actually, I think I've seen several rounds of their requests for startups now, which talk about it is that instead of selling software, you sell the whole service, but it's basically done by AI.
Yeah.
And it's you build and train your team to do the whole function, but you basically, it's a kind of AI-enabled business process outsourcing is what they're asking for. And I think that's what my guess is that's where you're going to end up with this business, which is fine, which is a very nice business, I think. Good job.
All right.
Do you have any
Thank you.
questions?
Yes. First, I am in a pickle sort of a situation. I am looking to understand whether I go client first or whether I go fund first, because I need somebody very strong in sales.
No,
In
you don't.
From
You
an
don't.
engineering perspective.
You don't. You're going to learn how to do this yourself. That's how founder-led sales works. Most startups are started by engineers who do founder-led sales, and if you need help to learn that, we will teach you. So you're not going to get funded right now. You're going to need to get the do the customer work first, and you're going to learn to do that yourself.
All right. That's the biggest one that I've been, trying to fight.
Okay.
Because
you got my answer.
Yeah.
So let me.
From your side.
I just gave you a whole lot of feedback. You will have the recording available, so go listen to that feedback a few times and extract whatever actionable items in there you find and execute. So now I like what you're doing. I think you can build a very nice business. If you decide you want to join 1M1M, I will work with you on a regular basis and help you build that. So let me explain to people how to use 1M1M, and I will take more questions from you and from the other people in the room as well. So 1M1M is a 100% virtual accelerator. We support solo founders, we support bootstrap founders, we support bootstrapping with a paycheck. If you're apprehending layoffs and you're trying to build a business on the side and create kind of your career lifeboat, as we call it, you're welcome to join 1M1M, and we are very inclusive and we're not obsessed about funding. Of course, we also help you get funded, but we have to get you there when you can raise funding. I talked about the digital mind earlier. You have our AI mentor available 24/7. And it is, as I will explain to you the programs, this is available on a standalone basis for $30 a month. You can just sign up for the digital mind and start working with the digital mind as much as you want. It is also included in our premium and basic programs. Premium is our full acceleration program. That includes weekly mentoring with me in this kind of roundtable format. And it includes investor introductions. When you're ready, we will help you get ready, and then we will take you to investors as you get ready. We have a terrific curriculum. So especially techies who are trying to become entrepreneurs have a bunch of business stuff that you need to learn. And so go ahead and do the curriculum and learn those things. And it is amazing how fast we can turn techies into entrepreneurs just using this curriculum. It's very, very well designed for that purpose. So premium is $1,000 annual membership fee. Basic is $99 a month. That's just the curriculum and the AI mentor. Premium is all of everything plus AI mentor. Basic is just curriculum and AI mentor. You're welcome to start there if you want, but if you want ongoing mentorship, that's something that's only in premium. So go to the website, look at premium, basic, AI mentor, and decide how you want to work with us and join. Some people ask for one-on-one consulting. I'm not suggesting you go to one-on-one consulting. It's much more expensive. It's $1,000 an hour versus $1,000 a year for premium. But it is available for those who are dying for private consulting. We have 3 more roundtables this month. So every Thursday, basically, we have roundtables. So you're very welcome to book a slot, and I will work with you. If you have questions about the program and you want to talk to somebody, Irina Patterson is your contact. Irina at 1Mby1M.com. She'll be happy to get on the phone, WhatsApp, whatever with you. Okay, who has more questions? Swapnil, if you have more questions, I'll answer now. Other people in the room, if you have questions, and if you want to talk to me, just let us know in the Q&A, and Maureen will put you on the panel, and you can ask questions.
I'm good.
You're good. Good.
Yes.
I like what you're doing. I really like what you're doing. I think
Thank you.
it's a very, very interesting company with that. Who else? Anybody else in the room? Yes? No? Let's see. I don't see any questions. If I don't see any questions, I'm going to adjourn. I will see you next week. If you're a premium member, I will see you at the private roundtable on Wednesday. And if you are looking to pitch for free at one of the private from public roundtables, that is going to be on Thursday. See you soon. Bye, everybody.
Thank you. Bye-bye.
Bye-bye.